How the U.S. government uses inflation to manage debt. When it comes to the continual effort that the United States government is making to manage the national debt, inflation is a potent tool that it uses. The government can exert influence over the state of the economy, exercise control of the money supply, and make debt more manageable through the strategic utilization of inflation. The manipulation of interest rates, the implementation of contractionary monetary policy, and the utilization of open market operations are all examples of the different strategies that are included in this complex approach. By gaining an understanding of the functioning of these processes, this sheds light on insight into the complex link that exists between inflation and fiscal and the efforts that the government is making to stabilize the economy while also meeting its debt obligations. Price controls are implemented. Limits or floors on prices are examples of price controls that are imposed by a government and are applied to particular products. It is possible to apply pay restrictions in conjunction with price controls in order to reduce the impact of wage push inflation. Over the course of 90 days, President Richard Nixon of the United States of America put a stop to salary and price increases in an effort to combat the rising rate of inflation. When inflation rose to its highest levels since the World War in 1973, this was initially popular and considered to be effective. Nevertheless, it was unable to control prices and was therefore unsuccessful. Despite the fact that there were a number of intervening circumstances, such as the conclusion of the Bretton Woods system, low harvests, an oil embargo imposed by Arab countries, and the complexity of the price control system in the 1970s, the majority of economists consider the decade of the 1970s to be sufficient evidence that price controls are an inadequate management tool for inflation. Monetary policy that results in contraction. These days, contractionary monetary policy is considered to be a more successful method of reducing inflation than other control methods. By raising interest rates, a contractionary policy seeks to accomplish the objective of reducing the amount of money that is available within an economy. This contributes to the slowing of economic growth by increasing the cost of obtaining credit, which in turn affects the amount of money spent by businesses and consumers. Additionally, higher interest rates on government securities limit growth because they encourage banks and investors to purchase treasuries, which ensure a defined rate of return, rather than the riskier equity investments that benefit from low rates. This is because treasuries guarantee a rate of return. The rate of the federal funds is the rate at which banks lend money to one another overnight that is referred to as the federal funds rate. The overnight lending system is a massive movement of cash among financial institutions that enables banks to employ their excess cash profitably or to retain the appropriate cash reserves they require to carry out their day-to-day operations. On the other hand, the Federal Reserve does not directly determine the Fed funds rate. Instead, the Federal Open Market Committee, FOMC, establishes a range of interest rates for the federal funds rate, Fed funds rate, that is ideal, and then changes two additional interest rates, the interest rate on reserves and the overnight reverse repurchase agreement rate, to bring interbank rates closer to it. The interest rate that banks earn on their deposits with the Federal Reserve is referred to as the interest on reserves. As a result of the fact that the United States has never failed to make payments on its debt, the interest rate on reserves is regarded as a risk-free rate, and is therefore the lowest interest rate that any rational lender would want. When it comes to financial firms that do not have deposits with the Federal Reserve, the overnight RRP rate serves a function that is comparable to that of another rate. Through the overnight RRP, these institutions are granted the ability to virtually buy federal securities throughout the night and then resale them to the Federal Reserve the following day. The difference in price between the price at which the security is bought and the price at which it is sold is the all-in RRP rate. The Federal Reserve hopes that increasing these rates will encourage banks and other lenders to raise the interest rates on their riskier loans and transfer more of their money to the Federal Reserve, which does not take any risks. Because of this, there is a decrease in the amount of money in circulation, which in turn has the effect of lowering inflation. The operations of the open market. The term open market operations relates to the purchasing and selling of Treasury securities, and one example of open market operations is the use of reverse repurchase agreements. Out-of-money operations, OMLOs, are a mechanism that the Federal Reserve employs in order to either raise or decrease the money supply by selling treasuries. When the Federal Reserve purchases securities, the balance sheet, which is a weekly financial report that illustrates what the Fed owns and what it owes, expands. On the other hand, when the Fed sells securities, the balance sheet grows. Acquiring securities increases the amount of liquidity that is present in the financial markets and exerts downward pressure on interest rates. When you sell securities, you are doing the opposite. Requirements for your reserve. The Federal Reserve also managed the money supply through reserve requirements between the dates of March 26, 2020 and March 26, 2020. Reserve requirements refer to the amount of money that banks were legally required to hold on hand in order to cover withdrawals. The greater the amount of money that banks were required to safeguard, the less money they were able to lend to customers. Even though reserve requirements have been abolished since that date, the Federal Reserve nevertheless maintains the ability to reinstate them at any time in the future. The discount rate is the interest rate that is applied to loans that are provided by the Federal Reserve to commercial banks and other sorts of financial institutions is referred to as the discount rate. It is referred to as the discount window, and it is the lending facility that is responsible for making these short-term loans. An agreement is reached between the boards of directors of each regional bank and the Board of Governors of the Federal Reserve System in order to determine the discount rate, which is the same for all reserve banks. Maintaining stability within the financial system is the major objective of the discount window, which serves to satisfy the short-term liquidity requirements of banks' operations. The discount rate, on the other hand, is yet another interest rate that can be increased in order to curb inflation. Is it difficult to maintain control of inflation? Workers are more likely to demand more pay when prices are higher. When employees obtain better income, they can spend more money at their discretion. This leads to an increase in demand, which in turn leads to an increase in pricing. A wage price spiral may result from this situation. Because the tools that are used to combat inflation, such as increasing interest rates, do not instantly affect the economy. It takes some time to bring inflation under control. How much time will it take to bring inflation under control? The amount of time required to bring inflation under control will vary based on a large number of different circumstances. When it comes to the effects of changes in monetary policy on inflation, it is generally believed that there is a 2-year lag before the changes take full impact. Who is working to stop inflation? The central bank of a country is the entity that is accountable for implementing monetary policy in order to prevent inflation. Changing interest rates is the primary function of monetary policy, which is largely used to control inflation. The implementation of fiscal policy through legislative action is also beneficial. To assist in bringing inflation under control, governments can choose to cut spending while simultaneously raising taxes. Final thoughts. In the management of debt, the United States government makes use of a variety of tactics, one of which is the utilization of inflation as a practical instrument. Modern procedures such as contractionary monetary policy and modifications to the federal funds rate play central roles in the regulation of the money supply. In contrast, previous tactics such as price restrictions are mainly ineffectual. The government can exert control over economic circumstances through the use of open market operations and the management of interest rates. As a result, it is particularly important for the central bank to carefully handle inflation. The ultimate goal of a combination of monetary and fiscal policy is to achieve economic stability and ensure that debt management can be maintained sustainably. Don't forget to like, subscribe, and drop a comment below. We love to hear your thoughts and stay tuned for more content.